today about some things that have happened in the Japanese economy. And there's a term for this called Japanification or a zombie economy. And I'll explain what that is as I go along here. History was made in February when the Japanese stock index, called the Nikkei average, closed at a little over 39,000 points, which was its highest close in history. And it's finally surpassed the previous closing high, which was on December 29th of, wait for it now, 1989. Yes, it took 35 years for the Nikkei to get back to where it was in 1989 and finally break even. I'm guessing you won't hear disciples of buy and hold use this as an example, but this is the kind of thing that happens all the time, and which is why we are proponents of active management, where if the market declines, we can just step out of the way for a few weeks, a few months, a few decades in the case of Japan. This first chart is of the Nikkei stock index, and you can see that a massive bubble formed in that index in the late 1980s. And this affected all assets, not just stocks. A spectacular crash followed it. The Japanese markets bounced along for about 25 years, just sort of chopping sideways. And then finally, a stock price recovery in recent years has brought them back where they left off in 1989. The cause of this bubble is real interesting. Now, this is going to be a little wonky, and I hope I won't lose you on this. But in 1980s, the U.S. dollar was the strongest currency in the world. And it might sound good, but it's really not. Overly strong currencies hinder manufacturers, exporters, even farmers who can't sell their goods to foreigners because those foreigners can't afford the dollars it takes to buy our U.S. goods. Our trade with other countries really suffers if the currency is too strong. Now, several of the developed nations of the world, a forerunner to what we call today's G7 nations, got together at the Plaza Hotel in New York to plan an orderly depreciation of the U.S. dollar. Now, currencies are measured against each other. They can't all go down at one time. If some go down, others must go up. Now, the dollar did decline as they planned it, but the yen, Japanese yen, took off, shifting the same problem to Japan. And unfortunately, Japan's central bank flubbed the response. And this is what led to the mother of all asset bubbles in Japan. Asset bubbles in the U.S., including the dot-com bubble in 2000 and even the 2008 housing bubble, were nothing compared to the Japanese bubble. In 1986 to 1989, the Nikkei stock index quadrupled in 3.5 years. The commercial real estate in Japan appreciated at 96% per year for 3 years. Residential real estate went up at 89% per year for 3 years. Now, to put this in perspective, if you owned a $500,000 house there, in 3 years, it would be a $3 million house. That's how much the Japanese stock markets and real estate markets just exploded in the late 1980s. Now, a basic valuation tool for stocks is called the price to earnings ratio. How many dollars you spend to buy a dollar of earnings of the underlying company or companies in the case of an index. The Nikkei's PE ratio back then was more than twice what it was in the worst U.S. bubble, our tech bubble in the year 2000. And it's about 4 times the historical average, according to the Bahnsen Group anyway. Now, the yen bought so many dollars back there that the Japanese started buying up iconic properties in the U.S. Japanese investors bought Pebble Beach Golf Club in 1989. They bought Rockefeller Center in 1990. But in the end, when the bubble burst, stocks dropped 35% in just a few months. Land values crashed, loan defaults surged. Japanese investors were forced to resell things like Pebble Beach was resold 3 years after it was purchased, 2 years after it was purchased, for a $350 million loss. They also were forced to sell Rockefeller Center in 1995 for the same reasons. In Japan, banks were collapsing and they entered a deflationary spiral, which is sort of a self-perpetuating negative feedback loop where loans default and banks default and lending dries up, so more loans can't be extended or rolled over, refinanced, and they default and causing more banks default, on and on. This is why deflation is such a big problem. The Federal Reserve actually worries about it more than they do about inflation. The bottom line, it was about 3 decades of economic stagnation in Japan. And this next chart shows a picture of the Japanese gross domestic product. And you can see in the center of the chart how it just took off in the late 1980s. Now, Ryan and I are chart guys, and here's how we would look at a chart like that. This next chart shows that I've isolated the bubble period in this blue circle, and I've also put a trend line along the bottom in red. And this is the rate at which Japanese economy was growing prior to the bubble. During the bubble, it got so overextended above the trend line, it was unsustainable. And markets can either crash, and they did a little bit in the early 1990s, and then they just chopped sideways for about 25 years. But really, the Japanese economy didn't have any real gains over that 25-year period. But if you look at the trend line, all of a sudden, the trend line had continued to rise to where it was just about where the economy was. And all of a sudden, the economy can start getting a solid footing again. This is why trend lines are so important in the type of analysis that Ryan and I do, because it can give us an idea of when things are going to turn around. In this case, the Japanese economy took off with a number of years of good stock market performance. What's the lesson in this for us? Okay, during the 3 decades of economic malaise in Japan, the consumer spending basically went away. Their manufacturing and technology prowess and their research and development just evaporated. They couldn't afford to invest in their businesses anymore. Zombie banks were kept alive. Now, zombies that's a technical term for companies that can't repay their debt and are kept alive with new debt that is given to them. And sometimes it's government money. Sometimes it's government guarantees of loans from other banks or something. But anyway, it's money coming in that keeps a zombie company alive. So zombie banks were kept alive. They were lending to zombie companies. They were keeping zombie capital and zombie businesses and facilitating a zombie economy where everybody changes seats on the deck chairs on the Titanic, but the whole thing was going down. I hope you get my point that this was not a good time in Japan economically. And the lesson for us in the U.S. is in the next business downturn, we must allow banks and businesses to fail. Now, this sounds harsh, but capitalism rewards good decision-making and punishes bad decision-makings. And if we bail out bad decision-makers, whether they're banks or automotive companies or whatever, we're just going to get more of them. And then we risk having what happened to Japan happen to the U.S. So if you want 30 years of economic malaise like they had in Japan, just encourage the government to do what they've done the last couple of economic downturns. If you don't want that, encourage them to act like rational capitalists and let banks and businesses fail if they need to.